All right. Today is Monday, September 12th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And look, I know that football season is back. A lot of you contacted me today saying, hey, I lost a lot of money over the weekend betting on football. Can you help me out here, Maverick? And I say, listen, kid. Football is a racket. Stick to the stock market. All what you have to do is follow the squeeze. That's all you have to do. Forget about football for now. And oh, by the way, happy CPI Eve. Now, a lot of people say, hey, inflation is going to go down. It's done. Inflation peaked already. It's dead. Let's go all in, Naruto style, heads first, buying stocks, buying call options, because when the CPI comes out tomorrow, you will see, all of these bears will see, inflation is gone. The Fed is not going to do anything, and here comes the soft landing. And I say watch your back. You know why? Because inflation is bad. How bad is it, Maverick? It's so bad in Mexico. Tortilla prices are surging out of control. And you know the Mexicans will tolerate higher gasoline prices, higher rents, higher utilities, doesn't matter. But the red line is tortillas. You screw with the tortillas, the revolution starts. And I guess the equivalent here in America would be, what? Oreos, chicken wings, beer. Oh yeah, the prices of all of these items went higher, and nobody did anything at all. You know why? Because we're zombified. We're so brainwashed and propagandized. Everybody's like, hey, the dear government says inflation is transitory. I don't know. See, if the population got mad about inflation from the get-go and the talk about the guillotines started to come out, you would have seen Jerome Powell raising interest rates. Forget about 4%. He'll go to 20%. But no, everybody just believed the propaganda. They say it's transitory. I don't know. Anyways, there's another problem here. The market is rallying ahead of the CPI. Which is not a good setup, because the market is saying, hey, the CPI will come out down, the dollar will go down, stocks will go higher, and that's that. And that is a dangerous assumption, because today Bank of America came out and said that investors are ignoring dangers of synchronized policy tightening. Now listen, we'll talk about that and a lot more in this program. And you know what? You don't want to skip the options market coverage, because I'm going to go over a lot of things. Among them, the retail traders are making massive bets. Massive using call options. We'll cover that. And I'm also going to follow up from yesterday's video that was for the members only, because you see, sometimes I just ramble and I go on in these rants and talks. And my bad, folks. I got to explain things a lot better. Yesterday we talked about the open interest, but there was a lot of confusion. So I'm going to explain to you what the open interest actually means and how can we use it to figure out where the market is heading next. And of course, we're going to preview the CPI in details. Let's not waste any more time, and here it is, in focus tonight. Whoops! What if I told you inflation went higher in the month of August? Yep. Before we talk about that, let's do this. As stock market investors and traders, what do we care about the CPI? We care about two things. The market reaction, which means the dollar's reaction, and the 10-year yield's reaction. Now, the general assumption is if the CPI comes out good, and we talked about that in details in yesterday's video, I don't care what good is. The market will tell me what good is. Is it going to be 8.4%, 8%, 7.5%? Who cares? The market is going to react, and by the reaction, we will know whether the market likes the print or not. Now, the assumption is the market will like a cooler CPI, showing that inflation is indeed cooling, already peaked, and moving down. Why would the market like that? Because it means the Fed doesn't have to tighten as much or as aggressively as we thought before. And the consensus, if we get a good reading, quote unquote, is the dollar goes down and the 10-year yield goes down with it. Why? Because when the Fed tightens the monetary policy, the value of the dollar appreciates. But when the Fed stops tightening or eases the tightening, or better yet, starts cutting rates and easing the monetary policy, the value of the dollar moves down. Likewise, the 10-year yield is a pulse of the Fed funds rate. If the Fed is about to increase interest rates higher by a lot, the 10-year yield is supposed to move higher, and vice versa. Now, is there a scenario where the dollar goes down and the 10-year goes up, or the dollar goes up and the 10-year goes down? Yes, there is. But this is not the consensus for now. We discussed that in details in yesterday's video, but the consensus is if it is a good reading, the dollar goes down along with the 10-year, and if it is a bad reading, meaning CPI moved higher or still hot, the peak inflation theory goes out of the window, then the assumption is the dollar goes higher along with the 10-year. So for now, these are the two scenarios we're going to concentrate on. I know what you're looking at right now. You're looking at the blueprint. Oh, so I go long commodities and say, stop the gambling. Right now, we're not really interested in finding a trade. We're interested in the market reaction. What are we going to do after that? The consensus is if the dollar goes down along with the 10-year, the NASDAQ, the technology stocks will appreciate. Commodities also tend to appreciate when the dollar goes down. And of course, emerging markets and cyclicals like the dollar down, etc., etc. When the dollar goes higher along with the 10-year, commodities don't like it, tech stocks don't like it, cyclicals don't like it, emerging markets don't like it. That goes without saying. It's not rocket science. However, somebody made this point yesterday. What if we get a so-called good reading from the CPI, meaning a weak inflation reading, yet the dollar goes higher anyways? Could that happen? What if we get a bad CPI reading, meaning inflation went higher, and the dollar goes down either way? That is possible, but what does that mean? What is the market saying by such a move? Well, you're not going to find a reasonable explanation to that. So we'll stick to what we know, what has been going on for a while now. The dollar and yields move hand in hand to the upside when we have expectations of more Fed tightening. They move down hand in hand when we have expectations of a pivot or peak hawkishness. You get the message. So with that out of the way, what are the most important components to the CPI, also known as the TSLA? But you know what's even worse than the CPI is the PCE. And the Fed, of course, likes the PCE because, as you can see, it has the tendency of downplaying inflation, the true nature, that is, of inflation. But so does the CPI, because yes, you might see that housing is a huge component of the CPI, but the devil is always in the details. You see, the cooks at the bureau, they cooked the formula to downplay the true nature of housing inflation. So either way, we know that inflation is being suppressed. But the point I'm trying to make here is housing, shelter is a massive component of the CPI. So yes, you could look at commodities, fuel prices are down, gasoline is down, utilities may be down, but so long as housing prices and rents continue to surge higher out of control, that could be the blind spot in the mirror that the bulls are not looking at. So keep that in mind. Now, this is what the CPI looks like. This is the last reading for the month of July 2022. And of course, do we care about the year-over-year reading? I don't care about the year-over-year at all. I care about the month-over-month, whether we have a trend of declining inflation month-over-month or not. Last month in July, the month-over-month reading, we got such a relief. It was a zero, meaning inflation did not grow month-over-month. And the reason is a lot of energy commodities went down. So fuel oil inflation, for example, energy commodities, gasoline, went down significantly month-over-month, and thus the zero reading in the month of July when it comes to inflation. But mind you, the core CPI, which excludes food and energy prices, actually went higher month-over-month in the month of July. And the Fed, of course, last year said, hey, food and energy, that is so volatile. So we're not going to look at that. We'll look at the core CPI. Okay, you want to play that game, Jerome Powell? Let's play the game. Let's look at the core CPI and then circle back to food and fuel costs. When we look at items besides food and energy, where can we find relief in this upcoming reading of the CPI? Is it going to come from new vehicles, for example? Well, here it is. The headline reads, average new car prices set to hit a record of $46,259 in August. The average monthly car payment also at all-time high. So the assumption here is new vehicles, that's not going to be it. We have to look for something else. Is it going to be used vehicles this time around? Well, when we look at the Manheim Value Index, it is moving down, but that doesn't say anything at all because we're looking at month over month. We know already that used vehicles prices already peaked, but what about the month-over-month reading from July to August? Let's do the year-over-year first. This is again for August 2022. We still have stunning readings. Compact cars up 16% year-over-year. Luxury cars up almost 4.5% year-over-year. Vans are still up 14% year-over-year because, you know, vans are the new American dream since nobody can afford a home. But here's the month-over-month reading. In August, the reading was 210.8. In July, the reading was 219.6. So yes, we have a relief month over month in used cars prices, at least according to this indicator. What about apparel? Are prices moving up or down? Did they move up or down in the month of August? Month over month, once again, folks. Well, here's the headline from Reuters. It reads, U.S. retailers slash clothing prices as shoppers cut purchases. This is the good news, of course. I'm going to share the bad news in a minute, but What about medical care costs? Be it medical care services or commodities, doesn't matter. Well, according to the Dallas Fed, in their own forecast, they see healthcare inflation moving higher. And the reason is we have wage inflation and the unit labor cost continues to increase. So we're not going to see relief from this one. What about the big one? Shelter. What's going on here? Folks, we know that rents are exploding across the country. In major cities, Phoenix, Las Vegas, San Diego, LA, New York, doesn't matter. Every city you go to, rents are exploding. And when we use real indicators, such as the Zillow index or any other index you want to look at, the reading is absolutely stunning. Yet the CPI is still lagging behind. Why is it lagging? Here it is. Well-known indexes of market rents, like the one published by Zillow, captures rents of units currently advertised on the open market, and do not capture rents for units occupied by continuing renters like the CPI does. Rents change when leases expire, which typically happens annually. This can lead to a lag between changes in indexes like Zillow's and those in the BLS rent measure. From the perspective of the CPI, this lag is not a problem. Of course it's not, as the CPI is accurately capturing what households actually pay in rent. The audacity these people have. However, it does suggest that the CPI's shelter inflation will likely increase in coming months as the tight housing market shows through to rents on all rental units. In other words, we're not going to see relief from shelter cost in the upcoming CPI. If anything, it's going to go higher. It should go higher, despite the cooking. What about transportation services? If we use the data from Hopper, in the month of August, the month-over-month change in ticket prices was down by 12%. So yes, we have a relief here. However, you see that line in purple in the chart? That is 2022. Now yes, it went down in the month of August, but it appears that it moved slightly higher by the end of August, number one. Number two, it is curling its way higher in the month of September. And oh, by the way, when we look at lodging, hotels, the prices are moving higher again, month over month, big time. But we're not going to talk about that. Now, let's circle back to the fuel and food costs. What about gasoline prices? We know that gas prices are moving down, and they moved down in the month of August from about $4.20 a gallon, which was too high, all the way down to $3.80 a piece, or a gallon, I should say, by the end of August. So that is a decline, but it's not as steep as the decline from June, July. What does that mean? If the bulls are hoping for fuel costs to drop the CPI month over month, you're not going to find the same relief you got last month. And even with the massive drop from last month, the core CPI was positive month over month, and the headline reading was flat month over month. So there is a risk here that even though gasoline prices went down in August, we could see the month-over-month reading moving higher, not just in the core, but also the headline. Now, what about food? Because last month, food was absolutely stunning. The inflation in food prices was 1% month over month, not year over year, month over month. And here's the new stunning data that we got from Adobe today. Groceries inflation is absolutely exploding out of control, while we see electronics inflation, or lack thereof, moving down to, let's say, average. Now, we know that electronics have been in deflation for a long time. And the reason is globalization, China, technology, etc., etc. But this is not the only stunning reading that we got from Adobe today. Food inflation year over year was up by 14.1% in the month of August. Now, you might say, hey, Maverick, who cares? The year over year reading 14.1%, who cares? We care about the month over month. And look, all in all, the reading will be negative. You're just trying to spread some FUD here. You're being too fixated on this piece of data. Oh, really? Here it is. The headline reads, online prices in the U.S. jumped 2.1% in August, led by a surge in groceries. 2.1%. That's the inflation month over month in online prices. Online prices in the U.S. rose 2.1% in August from the previous month, driven by a jump in the cost of groceries, according to the Adobe Digital Price Index. The sharp monthly increase pushed the annual rate of online inflation up to 0.4%, Adobe said. And listen to this. All of you peak inflation crowd, the previous month, online prices had declined from a year earlier for the first time since 2020. Before the pandemic, the price of goods bought via e-commerce had been falling steadily for several years. And look, the inflation in electronics, for example, is moving down. Severe deflation in electronics, like it's supposed to. We've seen inflation in electronics, and by inflation we mean still deflation year over year, but we got really close to zero and positive. This is during 2020, 2021, when everybody and their mothers were buying laptops and computers. You know the deal. But look at this now. The last reading for the month of July was negative for online prices. In the most recent reading for the month of August, which we are anticipating from the CPI tomorrow, was actually positive by 0.4%. So anybody who looked at this and said, hey, peak inflation, we're going down to deflation again, hold your horses, inflation popped back higher in the month of August according to Adobe, at least in online prices. In case you don't live in the Stone Age and you have to do things physically. And here it is. What about apparel? We said it went down month over month according to that piece of data from Reuters. But here it is, up 4.9% year over year in the month of August according to Adobe, after being negative last month. Now I know you might say, hey Maverick, this is the year over year. Who cares? We care about the month over month. You sure you want to see these numbers? Here they are. It is the mid column, month over month. Everything went higher with very few exceptions. Exception number one, electronics, down about 1% month over month. And then we have flowers, in case you're feeling romantic. That was down by about half a percentage point month over month. And then we have computers, down about 2.3% month over month. And sporting goods, down about 1% month over month. But look at this. Jewelry, up over 3.5% month over month. Toys, up over 3% month over month. And most importantly, at the bottom of the table, what about apparel? Up a stunning 8.72% month over month. Uh-oh. What if there is no peak inflation? What if the CPI comes out hot tomorrow and we see the dollar surging higher, we see the 10-year popping higher again, and all of this stupidity, the stampede that you saw today in the stock market, that goes down the toilet? It is a possibility, because here's the final product. Look at this. The Adobe Digital Price Index is actually positive in the month of August, meaning inflation went higher after being down in the previous month. And folks, let's say that inflation comes out hot in the reading tomorrow, and it pops back to 1.5%, even 2% month over month. Remember when President Joey B came out last month and he said, "Do you see the GPI reading, Jack? Went down to zero. What is he going to say now if it goes back up to 1%? The CPI is back 1%. Come on, man. Get your facts straight, Jack.
We choose truth over facts.
And you know what, Jack? It doesn't matter, because at the end of the day, whatever the market is going to do regarding the CPI, whether it goes higher or down, it doesn't matter. What matters at the end of the day is the cocaine, aka the liquidity from the Fed, aka the monetary policy. And for now, the consensus is whether the CPI is up or down, it doesn't matter, because it appears that Mr. Hawk, Dr. Payne, he has many other names, we're using the nice ones right now, Mr. Jerome Powell, well, it appears that he already made up his mind, and he's going to go with the 75 basis points. And this is what the market says, not me. The market says 75 basis points. But folks, it really boils down to how the dollar index and the 10-year will react. The dollar moves higher, that's not good for equities. That's not good for commodities. That's not good for a lot of things. Likewise, when the 10-year yield moves higher and we see the inversion in the yield curve deepening, that's not good for banks or anything else for that matter. However, if the dollar moves down, and we have a lot of technical indicators say that the dollar will move down. If it does, that's good for commodities. That's good for a lot of multinational stocks. That's good for emerging markets. Likewise, I don't know how the 10-year will react, but if it goes down, we're talking about yields, of course, that would be good for home builders. On the other hand, if it pops higher, that's not good for what? For technology stocks, the high multiple kind of stocks, the RKKs of the world. And as I've told the members in yesterday's video, a lot of folks want to trade ahead of time in anticipation of the big event. You can do that all you want, but there is a degree of risk. Now, you can be a conservative trader and wait after the move before you start trading. The problem is you're going to miss out on some of the gains, but the good news is, what if the bet goes the other way? Now you miss on the losses. And I feel that we have a lot of traders out there who would say, which one is it going to be? Which one is it, Maverick? Is the dollar going to go higher or down? Are stocks going to move up tomorrow or down tomorrow? Listen, if I really knew the answer to that, I'd be hiding in a bunker, being busy becoming the richest man in the world. I wouldn't be doing this show. So our job is not to be psychics or seers. Our job is to gather as many pieces of information as we can, accurate information, information, stitch all of that together, and come up with a rational conclusion. And the rational conclusion says the market's assumption right now from the positioning that started last week is CPI goes down, we have more evidence for peak inflation, the dollar goes down, along with the 10-year, we see stocks moving higher. There's a problem with that assumption, of course, which is if the dollar moves down, commodities will appreciate in value, and that produces more inflation. And hence, the bulls kind of lose either way, but this is what the market has positioned itself ahead of the big move, or the big event, we should say. On the other hand, there is the rational side, the more mature side that says maybe the market is wrong here. Maybe the market is getting ahead of itself because when we look at the data that it just presented to you from Adobe, that says inflation will move higher. On top of that, we have a lot of technicals right now that are overextended ahead of the reading, which means the risk is to the downside. We will find out which side is right after the CPI. And you know what? After the big move, we're going to have plenty of meat in the bone to chew on. In my book, we're not going to miss on anything at all. We're still going to have trades to conduct. And most importantly, we have the FOMC, which could kill the move after the CPI, whichever direction it's going to be in, or it could double down on the move, up or down. So we're still going to have plenty of trades to make. I don't see a reason why I would jump ahead of time and conduct a trade, for example, today, assuming that I know what the CPI is going to be. And even if I knew, I wouldn't know how the market is going to react to it. But folks, this is not what the market participants did today. They actually went all in, betting that the stock market will explode higher tomorrow. We'll talk about that in the options market coverage, so stick around. But for now, let's start by how the indices closed today. And here we go. The Dow Industrial Average closed in the green by 229.63 points, or a gain of 0.71%. The Nasdaq also in the green, leading the pack with 154.10 points, or a gain of 1.27%. The S&P 500 also in the green by 43.05 points, or a gain of 1.06%. What about the sector's performances today? All in the green, we're not going to shame anybody, but at number one, capturing the gold medal, it's actually a tie between cyclicals and technology, and therefore we're going to give the silver medal to energy, and the bronze, who cares? We're not going to give bronze to anybody. Either you're in the top three or not. Goodbye. Now, what about the advance to decline ratios? NYSE 81% advancing versus 17% declining. The Nasdaq 62% advancing versus 35% declining. And of course, the ratio for the Nasdaq was not that good. So why did the Nasdaq lead the pack? The answer is the Big Apple. Not New York, but Apple Incorporated. We'll talk more about that in the heat map analysis and the charts. But for now, let's do commodities. Green across the board. The dollar is down, commodities are higher. Some of them big time. In energy, both the WTI and Brent scored gains of more than 1% for the day. Similar story with the RBOB, gasoline. Heating oil, on the other hand, scored modest gains of a little over half a percentage point, but the party boy added once again natural gas with gains of over 4.75% today alone. When we talk about softs, look at the gains in lumber. Yes, lumber is down big since the top, but today lumber futures gained over 12% in a single day, along with more modest gains for OJ, cocoa, and sugar of about 1% apiece. Yet we saw cotton futures flat for the day. On the other hand, coffee was down by about 1.5%. Now, honestly, folks, when the dollar goes down, which type of commodity will benefit the most? The answer is metals. And in this case, look at this. Silver up big, along with platinum, copper, palladium, all up big. Palladium up over 4% for the day. Yet the mature guy in the room, gold, closed with, let's say, modest gains of about half a percentage point, despite the declines in the dollar. And the question becomes, of course, is gold saying, hey, watch out, the dollar is faking it, and tomorrow, after the CPI, the dollar is actually going to pop higher? That is a possibility, and therefore, gold is being conservative here. It's always been that way. And of course, when you add the manipulation by JP Morgan, that explains the other half. But anyhow, what about meats? It was a down day for both feeder cattle and lean hogs futures, down about 1.25% apiece. On the other hand, live cattle was pretty much flat for the day. What about grains? Gains across the board, some big time, over 5% apiece for both soybeans and soybean meal futures. Yet wheat was down. It lost about 1.25%. But a reminder, wheat futures performed pretty good last week. And here's the problem, folks. We have a labor strike here in railroads in the United States, and that could cost the economy about $2 billion a day. A lot of goods, a lot of commodities move via rail, and if rails are not in order, you can't sell them. We will see futures popping higher again. The problem is, you might see the underlying commodity moving higher in price due to the shortage of supply, but the company, the stock of the underlying commodity moving down because they cannot sell the product. And this could explain why, for example, fertilizer stocks were down big today. We'll talk about that more in the heat map analysis. But you got your beloved politicians now in Congress. By the way, aren't they in recess? I'm not sure. In any case, your beloved politicians are now waking up and they're, they're doing something about this. We'll see what happens. But for now, this could produce upward pressure when it comes to inflation. So watch out. Moving on to the big casino, the options market, what's going on here? The volume is slightly up, but most importantly, we're seeing more buying of calls, big time this time around. At number one, the hottest table by far today was Apple. At around 1.8 million contracts traded today, about 61% of those were calls. And at number two, Tesla, the souffle. At around 1.3 million contracts traded today, about 57% of those were calls. And at number three, Amazon, with around 650,000 contracts, about 56% of those were calls. And look at this, all of a sudden the put-to-call ratio, folks are buying more calls all of a sudden. We're talking big time. Do they know something ahead of time? Do they know something we don't, for example, the CPI? Or are they just gambling? I'd go with the latter, at least for now. Because look at this. In last night's show, we talked about the stages of a bear market rally. And I showed you the data that last week we saw short covering, number one. Number two, we saw a gamma squeeze. In many names, we identified the maximum pain points and why the dealer had to buy shares in the most major names in the stock market. And then we talked about the quant funds. When you have a 50 days moving average, the 100 days moving average, when we get a crossing above those, the quant funds start buying. And the last block, usually too late to the game, is retail investors. Why do they join? The answer is FOMO. And this is exactly what they did today. In one talked about Trade Monday, someone spent about $80 million in call options, wagering that the S&P 500 would rally to 4,300 by December, according to Piper Sandler. That followed a flurry of buying on Friday that sent the CBOE equity put-to-call ratio to the biggest drop since July. The taste for bullish bets is a reversal from late August, when a 3-week slump sent traders into put options, while skeptics warn the bounce is just a short squeeze. It puts pressure on investors, especially those whose annual report cards are due in coming months. They're gambling with your money, folks. I am in this business. I know what I'm talking about. They have no clue at all what they're doing. All what they care about is the report cards and the bonuses. That's all there is. There were several examples of investors turning upside calls for exposure to or protection against further momentum, both outright and versus downside put sales. Christopher Jacobson, a strategist at Susquehanna, wrote in a note, they could certainly be driven by investors who are underweight, looking to these upside calls for limited risk exposure. In other words, fear of missing out. I want to touch, but I don't want to go all in. Not right now. And therefore, they're buying call options. Among Friday's bullish trades in the options market flagged by Susquehanna was one that paid 53 cents each for 30,000 calls, betting that the iShares Russell 2000 ETF, the ticker IWM, would rise to 199 by month end. A wager that would break even if the ETF rises 6.6% by expiration. Another involved paying about $2.65 for roughly 15,000 contracts. These are calls linked to the XBI, that is the biotech ETF. Now, I'm bullish on the XBI, so maybe it makes sense here. And the strike price is 100 with the expiration date in November. That trade would make money should the fund jump more than 16% over the next 2 months. A little too out of the money for my taste, but while there are always traders buying calls or selling puts somewhere on any given day, the aggregate data from CBOE showed a clear pivot toward the bullish stance. The equity put-to-call ratio dropped to 0.52 on Friday, down from a high of 0.84 at the start of the month. Fear of missing out is suddenly back in vogue after investors, from day traders and professional speculators, turned sour on equities, while risk appetite remained subdued amid mounting risk from raging inflation to war and a hawkish Federal Reserve. The urge to chase gains is creeping up. Don't miss the gains, bro. God forbid you miss the gains. You gotta make the move ahead of the big event. Do you know what's going to happen? Do you know what the CPI says? Of course not. Maybe they're going to get it right. Who knows? It's a little too risky here and a little too arrogant, just like we saw back in the so-called summer rally. Now, before we move on to the unusual activities, let's cover the open interest, because I talked about that in yesterday's video and a lot of people got confused. Folks, the open interest is simply the open number of bets on a certain contract. For example, imagine a stock trading at 300 right now. The open interest for the 310 by the expiration date of this Friday, for example, these are the open bets betting that this underlying stock would be at or above 310 by expiration date, meaning by this Friday. Now, if the number of these bets, aka the open interest, increases dramatically in a short amount of time, and the value of this underlying stock starts to creep up closer to the strike price, in this case, in our example, 310, put yourself in the shoes of the dealer who's writing all of these call options. If we get to Friday, the expiration date, and this underlying stock is trading above 310, let's say 315, the dealer must buy this underlying stock at 315, the closing price on Friday, and deliver that stock to the contracts holders at $310 a piece, meaning the dealer will end up losing $5 a piece for each contract. That's a huge loss. So for the dealer to hedge against this outcome, what do they have to do? They buy the underlying stock, because in that case, let's say the stock closes at 315 by expiration Friday. The contract holders of the 310 calls now asking the dealer to deliver the shares at $310 a piece. Well, the dealer was smart. They hedged ahead of time. They bought the underlying share at 303 when they spotted the activity. Now it doesn't matter. They can deliver these contracts and make a gain off these deliveries of about $7 a piece. Is this clear, or is this like rocket science right now? Let me know. And this is, by the way, what is known as a gamma squeeze. Now, why is the open interest important? The answer is the change in the open interest can tell a story. Let's use the prior example. Folks bought the 310 calls with the expiration date of this Friday. The stock right now is trading at 300. It goes all the way to 305 by tomorrow, for example. And then suddenly we see the number of open interest, aka the bets for 310 by Friday, dropping. What does that say? It says a lot of the holders of these bets are booking profits and going away. Why would they do that? Because they don't have conviction that this stock will indeed close above 310 by Friday. They think something would happen by, let's say, Wednesday or Thursday, and the stock might close at 307 or even move down to 300, to below 300. So they're booking profits, and we know right away from the decrease in the number of open interest. Now, using the same example, let's say that the stock blasts higher to 307. We still have 3-4 days till expiration Friday, and we don't see a decrease in the number of open interest for the 310. We actually see an increase in the number of open interest. On top of that, we see a surge in the number of open interest for the 315 calls with the same expiration date. What does that say? It says that the bettors in this case have huge conviction that the stock will not only end up by the end of the week at 310 or above, but even above 315. So knowing that information tells you that the bias is to the upside. Of course, you have to compare the number of open interest for the calls versus the puts, because if the number of contracts in the nearer put outnumbers the number of open interest in the nearer call, then the bias becomes to the downside. And we see reverse gamma. Not the gamma squeeze to the upside, but the reverse gamma. This might be complicated, but pause, rewind, grab a piece of paper, listen to what I said again, and start writing stuff, and you'll get it. It's not rocket science, folks, and I'll give you a real-life example here. In yesterday's video, I showed you this. This is what the options grid looks like for Apple. These are the options contracts with the expiration date of this upcoming Friday. This is how they looked last Friday. I identified 3 important numbers for you and explained to you why Apple will see a gamma squeeze as we head closer to these numbers. The first one is the 160 calls, again for the expiration date of this upcoming Friday. The open interest for this one was at 79,000 contracts last Friday. Remember these numbers. The 165. The open interest for that was at around 95,000 contracts. And then we got the 170. Last Friday, we got 80,000 contracts almost as open interest for this one. As the stock moves higher, the dealer has to hedge by buying Apple shares because you have a huge demand in the open interest for these contracts. A lot of folks believe that Apple will be at 160, 165, even above 170 by this upcoming Friday, and the dealer has to hedge, and it becomes sort of a self-fulfilling prophecy. Now, look at what happened to these numbers today. The stock moved higher, big time, Apple that is. The 160 contracts, these are for calls. They're now in the money, and the open interest moved higher from around 79,000 contracts to about 83,000 contracts. Is this a sign of conviction or not? Likewise, the 165 calls. Last Friday, the open interest was at around 95,000 contracts. Now it moved higher to around 99,000 contracts. What about the 170 calls? Last Friday, the open interest was at around 80,000 contracts. Today, it remains also at around 80,000 contracts. So we have less conviction, at least right now, that Apple will be above 170 by Friday. They believe it will be above 160, 165, but not so sure about 170 right now. Still, there is a degree of conviction, but not a strong one. Now, what about the puts? This is what I showed you from the grid last Friday. The point of maximum pain is the 150 puts with the expiration date of this Friday. The open interest for that one was at around 95,000 contracts. Once again, last Friday, here's the update. They're upping the bets to about 100,000 contracts today. The problem is, where is the force of gravity? Which contract is closer to where the price is right now? Is it the 150 contract or is it the 165? Well, the stock is almost trading at 165. Therefore, the bulls have the advantage. Now, let's say the CPI comes out ugly tomorrow, and Apple drops down algorithmically in the morning, and it gets closer to 150. What happens then? Well, the dealer looks around and says, wait a minute here. All of these people holding calls, the 160, 165, 170, I don't think they're going to make it by Friday. I think the folks with the 150 puts are going to make it because Apple is now trading at 153, for example. Big drop in the morning. This is a hypothetical. Then the dealer has to dump Apple shares in a reverse gamma because those holding the 150 puts have the power now, and hence we would see an acceleration of selling in the stock of Apple. This is of course a hypothetical, but I am explaining to you how the dealer looks at open interest and how they make their decisions. Please let me know if this is clear, and if it's not, that's your problem. Anyways, let's move on to the unusual activities that took place in the options market today. We start with the ticker ARKK for Tesla witch Cathie Wood. Somebody sees more gains to come for RKK, and they bought the 53 calls. This is for the expiration date of October 21st with expectations that RKK could move higher and gain more than 16% by then. 16, not 60. That would be crazy. Mama Cathie can only wish for that. They paid around 90 cents a piece to enter this trade, all in all spending around $1.5 million. And then we have the ticker QQQ. This is for the NASDAQ. Somebody's hedging here, buying the 260 puts for the expiration date, October 10th, with expectations that the Qs could move down and lose more than 16% of its value by then. They paid around 60 cents a piece to enter this trade, all in all spending around $600,000. And lastly, what about the ticker JD for, you guessed it, JD? Somebody sees more gains to come for the name. They bought the 67.5 calls for the expiration date, November 18th, with expectations that the name could move higher and gain more than 10% by then, and they paid around $3.25 a piece to enter this trade, all in all spending around $2.2 million. Moving on to the heat map analysis, what's going on here? The mystery of Apple is now resolved. We know that Apple was lagging, and today the name decided to join the rally and exploded higher with gains of about 4%. All in all, it was a sea of green with few exceptions. Amgen in healthcare is one. Biotech was down. Biotech was an outperformer last week. We're seeing some profit taking here in biotech. Will the dip buyers show up? I bet they will at some point. And then we have agriculture in materials. We're talking about fertilizers. Also related food stocks in consumer defensives. They were all down today, big time. I couldn't find an explanation here besides the railroad situation. For example, for fertilizers, natural gas prices were higher today, so the fundamentals are good. Likewise, if the dollar moves down, the assumption is these stocks should move higher. But if the railroad situation is the problem because it could cause them to miss revenues, and that's going to be a problem for these stocks. But if the dollar moves down, let's say in reaction to the CPI, I see the drop in these names as an opportunity to add exposure. But again, the biggest beneficiary for a drop in the US dollar for good would be metals. We're talking about copper, we're talking about steel, we're talking about aluminum, we're talking about gold and silver. So this is what I'm going to be watching tomorrow. Now we have some corporate news for you. We start with JP Morgan. JP Morgan Chase now acquired some fintech company called Renovate or Renovite. I don't know what it is, but what I know, it is an effort to battle Stripe and Block. We know that JP Morgan plays dirty, so watch out here, Block. And you might have heard after the bell that, I'm trying to be nice here, but con man John Foley from Peloton is stepping down. He's leaving the board. Now remember, this guy was a pumper back in the day. He deceived a lot of investors by saying that Peloton will be the next Netflix. And of course, a lot of morons bought that. And since they like the bike, they also like the stock. I like Peloton. I should buy the stock, right? Stock is different than the product, honey. But anyways, a lot of folks lost a lot of money investing in Peloton. On the other hand, Mr. Foley, well, he walked away rich because he dumped over $500 million worth of Peloton stock before it went down. Right at the top. Folks, this is a Ponzi scheme. You're not going to invest in anything without fundamentals. This is a glorified bike company. That's all there is. It should have never been a stock to begin with. Moving on to the heat map analysis for the ETFs. Green across the board, but not by a lot, believe it or not. When you see the gains in the S&P 500 and the NASDAQ, Apple was behind a lot of that. Growth outperformed value by a little bit, but international markets were up. The majority of US ETFs were in the green. Some are lagging, such as the XLP, the defensives, but still in the green nonetheless. Commodities outperformed today. Natural gas, UNG, the ticker BOIL, B-O-I-L, up big. Silver rallied big time today. The SLV was up big. Now, when it comes to gold, the GDX gold miners were also up, but not as much as the SLV for silver. All in all, for now, this is the pre-CPI formation. Everything is in the green. Now, if I was a bull, I would actually wish that we get into the CPI battered and bruised, red across the board, but this is too risky here. It makes the disappointment factor to the downside. And for that, let's move on to charts. So we start with the SPY, the S&P 500 30 minutes chart. What do we see here? Another gap higher, another bull flag formation, but the risk is we're overextended in the momentum indicators, the RSI, the MACD. Matter of fact, the MACD already crossed, producing negative impressions in the histogram. Now mind you, this is a 30 minutes chart. It is not as significant as, let's say, the hourly or the daily, but it plays from the 30 to the hourly to the daily. They get also overbought, and then we see a massive pullback. This could happen right off the gate tomorrow if we have a disappointment by the CPI. Otherwise, the bull flag will play out if the CPI comes, let's say, cooperative. The support for now is 410, the resistance at 416. We have plenty of gaps below to cover and plenty of support lines. If 410 is gone, we have a gap below, and then we have 405, and after that we have 400, and that should hold unless we have a massive surprise. What about the daily chart for the continuous contract for the S&P 500? We're now in the danger zone. A big bounce since the trend line. The momentum indicators are improving. The volume is improving in the right direction. The volume is up on a buying day. All good signs for the bulls. And they're certainly above 4,100. No problems here. The problem is the move is too steep in a short amount of time. A classic bear market rally look. What does that mean? If the CPI comes out disappointing tomorrow, we will see a flush down. We will lose 4,100 as support, or we could go down right away in the vicinity of 4,000. And here is the Q's 30 minutes chart for the NASDAQ. A gap higher, bull flag consolidation, no problems here. Similar story with SPY. The chart is holding on 308.55, that is support. Resistance at 313, the famous 313. But the problem is the momentum indicators are getting overextended. That doesn't tell you a buy or sell signal, but it tells you where the risk is, and the risk is to the downside. If the CPI disappoints, big flush down tomorrow. Otherwise, the bull flag plays out, and we will visit Miss 313 once again. Here is the daily chart for the continuous contract for the NASDAQ. The good news for the bulls, number one, they're above the resistance, now support of 12,766. The volume is below average. The momentum indicators are improving. The problem is they did not fix the drop that we got in the reversal of the summer rally. You see that big reversal candle, aka the Dr. Payne candle? They have to get above that candle and close above it before we say we're out of the woods. And the problem here is a steep rally in a short amount of time that brings the risk to the downside if the CPI comes out disappointing. And a loss of the trend line in yellow once again would be a confirmation that down we go and the destination would be retesting the June bottom if that happens. What about the IWM, the Russell 2000 30 minutes chart? Another gap higher. It got us above an important number of 188. It is now support. The next number would be 191.5, but one step at a time, because just like the SPY and the Qs, this chart is also getting overextended, technically speaking, in the momentum indicators, which means the risk is to the downside. Here's the most important chart to watch, the dollar index. On one hand, we have a confirmation from the MACD indicator that the positive momentum is gone. That doesn't mean that the dollar has to flush down. The upward trend remains intact, but it means that the best gains are probably behind us. Will the CPI confirm the technical indicators, or will it negate it? We'll see what happens tomorrow. But technically speaking, this is the charts analysis after all. The risk is to the downside in the dollar. It is overextended to the upside. We have a crossing in the MACD. It lost the important support line in yellow. And moreover, when we visit the weekly chart for the dollar, we have a steep curve line, trend line, but we also have a negative divergence in the RSI. The MACD is begging to cross to produce negative impressions in the histogram. It is just a matter of time, folks. Is it going to happen tomorrow? Is it going to happen next week? Is it going to happen the week after? That's up for debate. But the point is, it's going to happen. And when it happens, commodities will appreciate, specifically metals. In this case, our friend gold, which remains conservative for now. He doesn't want to party, the old man, but he is still keeping an important support of 1,685, and we have a double bottom formation. Gold is waiting and waiting for a confirmation that the dollar is done rallying, and then we will see a pop in gold. And here's a daily chart for Brent oil. We have a bearish trend line, a sloping line of resistance. We have a negative trend of lower lows, at least for now. Once we see a higher low and we see a crossing with a confirmation above the sloping line of resistance, then we're good to go, because we've been fooled before in the false breakout, as you can see. What about a daily chart for the 10-year yield? Here it is, above 3.28. If this momentum continues, we have 3.5 next. But hold your horses, the CPI is in charge here. If the CPI shows that the Fed needs to do more, higher we go. This is the assumption for now. If the CPI shows that the Fed is done and they should tone it down, the 10-year goes down. This is the assumption. No guarantees here, because for all you know, let's say the CPI shows that the Fed should tone it down. Inflation is going down by a lot. You could actually see the 10-year popping higher for the good reasons, not the bad reasons. The bad reasons would be higher interest rate expectations. The good reasons would be a better outlook for the economy, better outlook for growth. This is what the 10-year is a pulse for. It's confusing, I know, but welcome to the bond market. Here's a weekly chart for the TLT. It is above 109.5. An ugly candle for the week so far. The trajectory remains to the downside until and unless we have some repair job. What is the repair job you're talking about, Maverick? Here it is. Recapturing 109.5 as support, number one. Number two, recapturing the trend line in yellow. And that is just the start. The VIX 4 hours chart. What's going on here? Look at the MACD indicator. It is negative for now, but it's about to cross. And if it does, it will produce green impressions in the histogram indicating the beginning of a new positive momentum. The VIX goes higher. Hard to see why the SPY would rally along with it. Likewise, we have a negative divergence for now on the RSI, but it could be reversed as soon as tomorrow. So this chart is not good for the bulls. This is a hope sign for the bears. We're betting against the stock market right now. And here it is, Apple, the big kahuna, a daily chart, massive pop today. It got us above 157 for good. It got us above the trend line. And it got us all the way to closing the gap at 163.62. But it did not close the day above this gap. Is this a big deal that Apple is done here? Of course not. The volume went higher big time on a rally day. This is a good sign for the bulls. The problem is, what if their assumption is wrong? What if their positioning is wrong? They're Johnny-come-lately. They looked at the rally last week. What is the laggard? Apple. So they buy call options today. They buy the underlying stock. What if they're wrong? They're going to stampede to the exit door, and we will see this move reversing big time. If the CPI is disappointing, Apple could be one of the biggest losers here. What about Tesla? An hourly chart. What's going on here? The bull flag played out. We have another bull flag. The problem is We're running out of time. What do I mean by running out of time? I mean running out of gas. Look at the momentum indicators, the RSI, the MACD. They're overextended. They're about to weaken. Hard to see a bull flag playing out with such formation in the RSI and the MACD. Is it possible? Yes, it is. It happened yesterday, but you're running out of time. And the higher they go in this formation, the bigger the drop. And therefore, I have my question mark next to the bull flag. The bears have a lot of things to look for. They're not going to start shorting right now until we see 298 is lost as support. And on top of that, maybe the gap below closed and the chart closing below that gap for the day. That would be a confirmation that we're going down back to 280. And lastly, what about tulips? 4 hours chart. What's going on here? It continues to move higher, but just like the SPY, just like Tesla, just like the Qs, it is running out of time. It is consolidating in a bullish pattern, waiting and waiting for the CPI to give the go-ahead for a blast higher. The problem is, the risk is to the downside. If the CPI says risk off, all of these overextensions in the RSI and the MACD will produce a big flush down in Bitcoin. And if that is the case, you can play it via Bitcoin, you can play it via many other proxies. I like to play it via Coinbase, the ticker COIN. The chart stopped at my number of 83.48. It's actually not my number, it's a gap. We have negative divergence on the hourly chart. The MACD is about to cross. The risk versus reward says if the CPI comes out disappointing, saying risk off, Coinbase will go down big. Therefore, I am at the initiation stage of the options trade, meaning I have the 10 to 20% of the intended position on. If we go down and I get my confirmation, I'll add more. But for now, I'm only adding 10 to 20% because what if I'm wrong and Coinbase blasts higher tomorrow? No harm done. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? In case you were asleep throughout the video, we have the CPI, the Consumer Price Index tomorrow, aka the CPI. On top of that, we have the Small Business Index. Highly important. Besides that, this is all I got for you for now, folks. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
The only trouble is we could have...
Pardon me.
Yes. The only trouble is we could have had a lot of fun if you weren't a detective.
We still can.
So long.
Can you see?